Howdy, everybody. Welcome to Liberty Call. It is, what is today? I think it's Wednesday. Yeah, Wednesday. May 29th, 2024. Hope you are having a fantastical day out there. It's a little gloomy here this time of the day. It's, 2:49 here, Mountain Time. It was sunny, and I was hoping to get outside and get some playtime in the sun. I did not get a lot of sun on my cruise because, A, I was sick all week and stayed mostly in the shade, and B, I did want to get a sunburn, so I did, when I was outside, did try to cover myself up. So anyways, hope you're having a fantastical day. If it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. If you see Jake back here, he's my main man. He's our security director here at the global headquarters of DSA Financial Group. So if you see him wandering around or snoring, I apologize now. All right. Ugly day in the markets. I have no other way to say it, but started out ugly, ended ugly, and looks like the kind of a contagion across the globe. So let's go ahead and start there. Dow Jones finished the day down 1.06%, 411 points, closed at 38,441. And again, I apologize, my nose is still stuffy, so I probably sound weird if you're just listening online. All right. SP 500 was down 0.74%, closed at 5266. NASDAQ down 0.58%, closed at 16,920. The VIX up 10.53% today. It's at 1428. Still not in what I would consider the danger zone. Still pretty low for what I consider where we're headed. But hey, it'll probably get worse. Canada down 1.65%. Brazil down 0.87%. Mexico up 0.05%. So hey, one bright spot here in North America, or in the Americas. Let's see. Over in Europe, Germany was down 1.09%. The UK down 0.86%. France down 1.52%. The Netherlands down 0.7%. Spain down 1.16%. Italy down 1.47%. Switzerland down 0.55%. And Portugal down 1.62%. Russian exchanges were mixed today. The MOEX up 0.44%, the RTSI down 0.54%. And the overnights, the Nikkei in Japan was down 0.87%, Australia down 1.3%, New Zealand up 1/3%. In China, mostly green, the Shanghai up 0.05%, Shenzhen Component up 0.26%. China A50 up 0.2%, DJ Shanghai up 0.08%, Hang Seng down 1.83%, Taiwan weighted that closed on the 28th was up 0.25%. All right, so those are the markets for today. So we'll get to the news in a second and find out what exactly happened. It was, like I said, I've been catching up on work and going through a bazillion emails and everything else. And it's like, I just keep looking at my chart over here and I'm like, what's going on? I mean, personally, I'm not really surprised. The economy, in my opinion, stinks. So, for any, actually, let's bring up the chart. We haven't done that in a while. So, just looking at it here, the last, starting in the beginning, or was it mid-March, it's just been down, up, down. Just back and forth over the last few months, and no real direction on the markets. And I would also even say the economy too. So very, very weird. All right, let me get my articles back up here. All right, let's get to the market recap for today. Stock market today, Dow closes lower on rising yields. Plunge in American Airlines. So let's go ahead and dive into that. The Dow closed sharply lower on Wednesday, influenced by rising treasury yields and significant weakness in industrial stocks, particularly airlines. American Airlines cut its Q2 profit guidance, leading to a 13% drop in its shares and sparking concerns about competitive pressures from low-cost carriers. Seaport Research Partners downgraded AAL to neutral from buy, citing persistent revenue challenges due to escalating competition at major hubs. This sentiment negatively impacted other airline stocks, including Delta and Spirit. Energy stocks also dragged down the sector despite a surge in Marathon Oil following its agreement to be acquired by ConocoPhillips in a $17.1 billion all-stock deal. The overall energy sector struggled to maintain gains amid the broader market downturn. U.S. Treasury yields continued to rise after a series of weaker than expected auction results, indicating reduced demand for government bonds, including a $44 billion auction of 7-year notes on Wednesday. The increase in yields precedes the anticipated release of the PCE price index data on Friday, the Federal Reserve's preferred inflation gauge. The data is expected to influence the central bank's outlook on interest rates, with some officials expressing the need for more evidence of cooling prices before reducing rates from their current high low. I know I laughed just saying that. This is not high interest rates. High interest rates is 20. 20 would be high interest rates. This is normal. So I hate to break it to the millennials and zennials out there, but this is what I grew up with. And, when you were born, these were the interest rates you had to, that were going on in the 90s and early 2000s. So again, hate to break it to you, but, you paid more than zero to borrow money in normal times. All right, let me get back into my article here. In the corporate earnings sector, Salesforce was set to report its fiscal first quarter earnings with attention focused on updates regarding its data cloud division. Dick's Sporting Goods saw its stock soar over 15% after raising its full year guidance, driven by strong sales of sneakers and athletic gear. Well, they don't sell guns and stuff anymore, so that's probably where they make their money. All right, and closing out here, Robinhood gained 3% following an announcement of a $1 billion stock buyback plan. Meanwhile, BHP Group fell slightly after abandoning its acquisition plans for Anglo American, as Anglo American refused to extend negotiations beyond the May 29th deadline. Overall, the market reflected concerns over rising yields and competitive pressures in the airline industry and a broader economic uncertainties ahead of key inflation data. So yeah, it's a mess out there, folks. All right, so let's dive a little deeper into the consumer confidence and inflation worries. U.S. consumer confidence recovers. Inflation worries are persisting. In May, U.S. consumer confidence unexpectedly improved after 3 months of decline, buoyed by optimism about the labor market, despite ongoing concerns about inflation, anticipated higher interest rates over the next year. The Conference Board's Consumer Confidence Index rose from 102 from 97.5, sounds like a radio station, in April, outperforming economists' expectations. This increase in confidence was observed across all age groups, especially among those with annual incomes over $100,000. So basically the middle class at this point, because everything is so expensive that a six-figure salary is the old 40 grand a year that was pretty comfortable back in the 90s. Consumers were upbeat about the stock market, with 48.2% expecting stock prices to rise over the next year. Really? Based on what? I'm not going to get into it. And many plan to purchase major household appliances in the coming 6 months. However, the survey also indicated that more consumers believe the economy might slip into recession within the next 12 months, though most economists and business executives do not foresee a downturn. Of course not. Why would they say that? If they were like, yeah, things look really bad, it's just going to speed up the process. You keep the consumer, confused and fooled that, oh, everything's fine. Let me go out and, redo my house or whatever, when I should be saving my ducats for a rainy day, when things get bad in the next, year or so. But hey, I gotta be completely off. The people driving this industry could be completely doing things great. I just don't see it. So I hate to talk like Joe Biden. He does that whisper into the thing. So, but seriously, folks. Let's see. The labor market remained robust, with the survey's labor market differential widening, indicating continued strong job availability. Despite this, inflation expectations rose slightly to 5.4% from 5.3% in April, with consumers particularly concerned about rising food and grocery prices. Duh. Consequently, more consumers expect higher interest rates in the year ahead. Stock markets responded positively, with the NASDAQ index reaching a record high, with U.S. Treasury while U.S. Treasury prices fell. The dollar weakened against a basket of currencies. The U.S. housing market index showed mixed signals, while house prices increased by 6.7% in March compared to the previous year, driven by a housing shortage. They keep saying this. I've never really experienced a shortage. There's always been homes wherever I've wanted to move to. The pace of growth slowed from February 7.1%, despite higher mortgage rates and elevated prices. The scarcity of supply and strong demand, especially from millennials, are expected to keep house price growth positive in the near term. So there's that. Again, I mean, if everything was, rainbows and unicorns and everything just looked wonderful, I could see the optimism. God, I had my beard all perfect and then I messed with it before the show and now it's all just everywhere. Anyways, like I said, if everything was wonderful, I could see the optimism. I'd be like, hey, I'd be doubling down. I'd be like, no bonds. We're going all stocks. No gold, no silver. We don't want anything weighting down our portfolio. We want growth. I see, that sort of attitude is being very dangerous out there right now. So anyways, one last article here comes from our buddies over at Zero Hedge. Ugly Beige book, negligible job gains, lower discretionary spending, and more pessimistic outlook. So we had one side of it where everything looks good. So let's get to the other side of things. The latest Beige book from the Federal Reserve, covering early April to mid-May, showed minimal economic growth across most districts, with several indicating no change in activity. Economic growth for Q1 had sharply dropped to 1.6% from over 3% in Q4, and further declined to 1.3% is anticipated. Key highlights include negligible job gains, lower discretionary spending, and a more pessimistic economic outlook. Retail spending remained flat to slightly up, with consumers showing heightened price sensitivity. Auto sales were stagnant despite manufacturers offering incentives. I'm seeing a lot of that on TV. Car prices are going down, so they are trying to move inventory. The travel and tourism sector showed strength, but hospitality outlooks for summer were mixed. Non-financial services demand rose, while transportation services saw mixed results with increased port and rail activity, but variable trucking and freight demand. Manufacturing activity was generally stable, but showed declines in two districts. Credit standards remained tight, and high interest rates constrained lending growth. Housing demand rose modestly, and single-family construction increased, but higher rates impacted sales. The commercial real estate sector softened due to supply concerns and elevated borrowing costs. The energy sector was stable, while agricultural conditions varied, with improved drought conditions but continued concerns over farm finances. Employment growth was slight, with better labor availability reported, though some industries face persistent shortages. I wonder what those are. Probably like picking berries and stuff. Wage growth was moderate and showing signs of normalizing to pre-pandemic levels. Consumer resistance to price increases was noted, leading to smaller profit margins. And retailers offered discounts to attract consumers, and input costs, especially insurance, and continued to rise. Regional reports varied, with districts experiencing slight to modest growth or stable conditions, while some regions saw improvements in consumer spending and labor markets. Others faced declines in manufacturing demand and commercial real estate. Overall, the outlook grew more pessimistic amid rising uncertainty and greater downside risks, despite some areas showing resilience in labor markets and consumer spending. So again, it's just a giant mixed bag out there. And if you're, sitting around thinking, hey, everything is wonderful. I mean, certainly, don't move to the woods. And, I live in the woods. So, but I choose to live out here because I despise people. So, the fact that, you don't have to change your life. You may want to get away from cities. I'm not going to dissuade anyone from getting away from Houston. I mean, it's, more than 6 million people shoved into a very, very tight area. It's not going to be good if things go sideways really badly. But if you already live in a small town, you're probably okay. Maybe have some extra food, money, silver, gold. Is that a deer out there? No. Anyways, it's just being prepared right now is probably the best thing, because remember 4 years ago, things got really weird really fast, and the people in charge are idiots. So I think that's something we can all agree on, right? All right. Well, all righty. Well, that is everything I had for today. If anyone needs anything from me, please go to, where is it? DSAFinancialGroup.com. All my contact information's there. Hope everyone has a wonderful evening. Me and my man Jake are going to go outside, get some sun and get some exercise. And I hope you have a wonderful evening. And I shall talk to you again next time. Adios. Bye-bye.